Because if it was like 100% invested in the S&P 500, in almost any 20-year period, there'd be enough volatility to bring the thing down so your initial capital goes to zero.
But not the full capital.
What? Not their debt?
Not your leverage capital.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome back to Skippy and Doogles. Before we get started, please rate and review the podcast. Helps people to follow us. Listener mail, skippydoogles@gmail.com. We love your comments. We love your questions. Skippy likes to say we like these things, don't love them. I love them, personally. That's just me. We here on the show, big proponents of more people participating in capital ownership, especially stocks that we talk about. Aren't we, Skippy? You agree, disagree?
100%. It's an easy path to wealth that more people should take advantage of.
Exactly right. However, sometimes the markets go too far. Most times, I'll even say the markets go too far when it comes to how do we get more people to take advantage of, I'm going to call them financial quagmires, in order to get more stock into their hands.
Wait, is the financial quagmire here the rich get richer? Is that, what are you referencing?
Sometimes everybody gets poorer. Specifically, what we're going to talk about today are two different, maybe you can split into three different categories. There's one category that's all around people getting into more debt in order to buy more stock and or assets. The other category is around trusted financial advisors, which are, and by the way, none of what we're going to talk about today is all bad, like in every case. However, we're talking more categorically how sometimes, maybe oftentimes, people can fall into situations that are systematically engineered to have hidden fees, sounds too good to be true type of schemes. Ooh, maybe scheme too aggressive. Did I go too far with the scheme?
You're going to go too far in this entire episode.
Yeah. Right. I probably am. And at the end of the episode, we've got Inside the Trade for the premium subscribers, skippydoogles.supercast.com. Premium subscribers, Inside the Trade. All right. So category one, where we're going to start off with getting into debt to buy stock. Category two, where we're going to end with our trusted financial advisors, high fees, that kind of situation, which also sometimes can be hidden or can be sneaky.
Anytime someone wants to disassociate you from your wealth, the easiest way to do that is to make the clear costs fuzzy, right? The U.S. healthcare system does this and does this incredibly well, and this is one of the reasons there's so much waste in the U.S. healthcare system. You go to your doctor, and a lot of times the doctor, you say, how much will this cost? And the doctor says, I don't know. I have to check with your insurer. Then we have 7,000 middlemen in the way of that simple conversation. And then at the end of the day, you're not even sure how much you spent because there was the list price, there was the actual paid price, there's the cash price, there's what your insurance covers this time of the year if you haven't met your deductible, what your insurance covers later in the year, right? So anytime that someone is trying to, what did you say earlier, swindle you?
I called it a quagmire, and I said scheme. Those are the two words I used.
Well, in healthcare, I'm more comfortable using swindle. They make it so it's fuzzy. They make it so you can't walk into the grocery store and buy the stick of gum for a fixed price and actually make that decision in real time if that value works for you, right? In financial products, we can go way back to like the 30s in this country.
Which is, for the record, that's where we're trying to go back to in this country, just overall right now. So this is
chill. You can go way back, and there were natural accidents, or in some case, purposeful accidents that happened that allowed brokers to charge fees that didn't necessarily clearly flow down to the owner of the stock. That culture has continued. It continued today or this week in an egregious way. I mean, can we talk about this first? There's a new company called Basic Capital. I think you should take it from there. But this is why we are talking about this today.
Yep. And I'm gonna build up before we get to basic. I want to build up a couple little other pieces of context. I like that you started going into context, and one of which is participation in the stock market in the U.S. has gone up over time. Generally, it ebbs and flows around market crashes.
It ebbs and
booms.
flows around market crashes. Yes,
Yes.
It was at a near all-time high in like 1999, and then it came way back.
Mm-hmm.
It's at a near all-time high right now.
Exactly. But if you go back roughly 35 years ago in the late 1980s, we were around 30% roughly market participation, and now we're around like 60%. So generally speaking, the line has gone up, but it has gone around, if you took like the 50% mark, half of people participating, it goes up and around that, around market crashes. But generally speaking, it's gone up. That's the thing that we like. The debt part is the other piece of context. We've talked about consumer debt on here, and this is a stat that I may have had in my head, but as I was researching for the show, it popped back up. Consumer debt 20 years ago was about $9 trillion. Today, it's around $18 trillion. Consumer debt in general has doubled. Now, we're talking about investing here. So now I looked at margin debt. Margin debt in 2005 was a little bit over $200 billion. So that means that people that were investing had roughly $200 billion in capital that they had invested that was not their capital. It was borrowed capital. Today, that's almost $900 billion. So that has gone up by roughly 4.5x. Consumer debt has gone up by about 2x. That's just context for folks to have in mind. As we talk about, we'll start with basic capitals. We just talk about people going into debt in order to buy stock, people getting more into the stock market. You also have to couple that with leverage, because the two of those things are what cause real market crashes. When you have participation that is led by debt. Anything you want to add there before we go to basic capital?
Well, I mean, I'm just so old school that I don't even consider, like, I would never consider taking out debt to buy equities. So I have a hard time fathoming it.
Okay.
This doesn't make sense to me, but thanks for the stats.
You got to take your old man hat off just for a moment.
It's
for
tough
people.
for me, yeah.
It is. It really is, because your toupee comes off at the same time. Okay. I'm going to play a small clip for you. And this is an interview with the founder, Abdul Al-Assad, founder of Basic Capital. So the question that was just asked is, what is the product that you're offering here? The reason I'm playing this clip is because I want people to hear from his mouth what the product is, not just from us, and then we can talk about it. But I want people to hear how he describes it. You ready?
Yep.
Of course. The product that Basic Capital has is that we're primarily a 401k platform that enables people to have more investing power, to add financing to their investing. This financing is non-recourse, meaning you're not personally liable for it. It's only secured by your investments. It has no mark to market, so if the value of the assets move up and down, it does not matter. You can keep the financing. And it's invested in not anything you want, like a Trump coin or a meme coin. It's invested into diversified stocks and bonds. The diversified stocks and bonds generate a larger yield than what you pay for financing. And that creates a positive spread or more capital, and you can reinvest that and grow over time. The way to think about it is when you...
All right. So that's what I'm going to play for you here. Now, what I will say is what he goes on to do is he says the way to think about it. What he goes on to do is to compare it to the mortgage market and say, when you go to buy a home, most times, people buy that with 4 or 5 times leverage. You put down your 20% down deposit, you then buy the house, so you're buying an asset with a lot of debt. However, why not do that with stocks? So that's his take. Okay, just want people to hear that. So direct from him.
Yeah, you just said down posit, which down posit is we need to make that a new word. That's hilarious.
Yeah, so there's up posits. Are you familiar with up posits?
Not at all. So that's the talking point that matters. And I even want to try and reset because most people listening to this show has never heard of Basic Capital. So that's the pitch. Someone walks in and says, hey, did you know stocks generally go up over time and they're a good investment? And do you know that rich people take advantage of that upside more than everyone else? And did you know that just like for your mortgage, it might make sense. Like, it might make sense in this case means I could build one spreadsheet that says if you take out debt to buy equities in a way that you would for a home mortgage, you'd be better off. So, gosh, all these stupid words get thrown around. Like, he probably says he's going to democratize finance or something. I would
Probably.
not even sure what his catchphrase is. He's going to go, "Oh, I'm Robin Hood here. I'm here for the little guy, and all you have to do is give me your 401k, sign some terms about 4 fees that I'm going to charge you, which we'll talk about later, and then your 10,000 becomes 50,000." And think how great that is, because you get 50,000 invested in stocks and bonds immediately, which is a lot more than 10,000, and you're going to be rich.
Yeah.
Let's go celebrate, right?
Yeah, that's right. You nailed it. Next topic.
Unfortunately, it's not quite that simple.
And we will talk through the 2 different examples of this. So on one side, as he says, this is predominantly a 401k platform. So they go and they sell to businesses for them to be the 401k administrator. So if you're at your company, you can invest them 401k. They also have a product that's also in the retirement space, but it's on the IRA side. So you can roll over your 401k, roll over your IRA to them. And so as an individual, you can have an account. We're going to talk through both of those. Do you want to start with the 401k?
Okay, this is long. I apologize. It's a slight detour too, so bear with me.
Okay.
Here's a quote. It's about savings and cash. I'm going to connect it to debt. Every bit of savings you have is like taking a point in your future that would have been owned by someone else and giving it back to yourself. When you think of it in those terms, I think savings becomes much more important and interesting and fascinating. That flexibility and control of your time is an unseen return on your savings. If people ask, what's the return on cash in the bank? You spit out, I don't know, 3%, 4%. If you think of that as optionality for your future self, the return on investment could be infinite. It could allow you to switch jobs when you want. It could allow you to take a vacation that's meaningful to your life. That quote started,
I love this.
That quote started as Morgan Housel. I freelanced the last half because his write-up is too long. So there's a flip side. There's 2 coins here, right? There's the, I want to be rich. So sure, if someone gives me $40,000 of debt to invest in my future self, that sounds great. The optionality that you just gave away in that trade, before we even talk about the mathematics of this, is huge. This happens with every decision a person makes to do more debt. So when you sign up for your house, and most people do that with a fair amount of debt, that's one thing, because it's the place you and your family live. When you sign up for debt for a car, that's not something I love. That's not something I typically do. That sacrifices your optionality for the next 5 to 7 years for that car. When you start doing that in other places, like, man, you just box yourself into this life, to this retirement plan, to all these things, and you have no options down there.
I love that you started with that. I'm going to build off that and walk through the IRA example for basic capital. So everyone, keep what Skippy just talked about in mind around optionality when I walk through this example. Because, as you mentioned, this example is one where you walk through it and you go, sign me up yesterday, Brosafina. So here we go. All right, I'm going to start with $100,000. So this is a rollover account. So everyone, a rollover is when, let's say you have a 401k, you leave your job, you decide not to leave your 401k with that job, but instead you roll it over into an IRA that you manage yourself. Let's just imagine that's the scenario. So you roll over your $100,000 401k into an IRA. You go, oh, look at that basic capital. Love it. So you roll it over into basic capital. They then give you $400,000 because they'll give you up to 5 to 1. They then give you $400,000 in debt. So you have a $500,000 portfolio. All right. The example I walk through is over the course of 20 years, what happens. And I used the last 20 years of actual returns just to use something real.
I'm going to let you go, but this example is ridiculous. 1, very few people have $100,000 in their 401k. 2, the last 20 years is like crazy good performance. That's not representative, but go for it.
So first of all, this is easy math. $1,000 is just easy math.
I know it is.
Second of all, we do have a 40% down year in the last 20 years. So it does give something, but I hear you. I agree with you. Okay. So let's just take this scenario and then we'll get to the optionality point. And through this, I'm going to walk through the fees that they charge.
Mm-hmm.
So you have $400,000 in debt. The way that they charge you for that is currently it's a 6.26% financing fee. So on that
A floating
$400,000
rate. I
Yep.
said I was going to let you talk, but it's really important to note that that's a floating rate. And that could be 10% very soon. So go.
Yeah. But so you're paying that, the $400,000, different than margin. It's like a normal loan. So you're paying that $400,000 over time. So keep that in mind. Another fee they have is they have a 0.5% AUM, like asset fee. So 0.5% of your assets, you're also paying to them. And then they have a $25 per month, like maintenance fee, just account fee. All right. So I incorporated all those in here. So you've got your $100,000 that you rolled over, which becomes $500,000 that you're investing. At the end of that 20-year period, your account is now going to be worth, are you ready for this? Can you do this? It is now going to be worth about $1.8 million at the end of this. You would have paid about $370,000 in fees to basic capital, and you would have about $120,000 in debt. Now, the reason that I'm connecting this to what you brought up, which is I think is a great point in optionality, is because independent of all the asterisks which are real that you just gave around the amount, the time period, etc., you can look at a spreadsheet like this and say, yeah, ordinarily, if I just put in $100,000, I would have had like $650,000 over this period of time. I have 3 times as much. That's great. Like even with all these fees, basic capital, you should make money because I did all this. But during this period of time, when you go from $400,000 in debt and you gradually go down to $300,000 to $200,000, you can't go anywhere. Even if this scenario, which is one of the best run-ups in the history of the U.S. stock market, happens for you. 5 years in, when you have $300,000 in debt to basic capital, and you say, I want to change my provider, I want to anything, optionality effectively goes away without.
I mean, you mean the average person can't just write a $300,000 check to get their optionality back?
That's exactly right. You are beholden. And that's if you look at starting amount, you put in $100,000, you end with $1.8 million. You go, yes, sir.
I've got to push back here.
Please do.
Appreciate your example. I saw. How do I say this? I did not find this example incredibly interesting this week, so I did not build my own spreadsheet because I saw 4 fees: a subscription fee of $25 a month, a management fee of 0.5%. Financing cost of 6+%, and you forgot a 5% carry, which means they get 5% of all the profits you make.
Yep.
I saw a few people build out an analysis. It seemed to me that in current market conditions, this is for the 401k product, you have about a 40% chance of making a little bit of money after the financing costs. You have a 20% chance of your initial funds disappearing and going to zero, and you have a 40% chance of like roughly breaking even. The one thing that's very interesting about the way they allocate your funds is it appears to be that they'll do about 85% of your funds in bonds, typically corporate bonds. Some stuff which I believe may even be considered junk bonds. Well, the reason they do that is they're trying to limit volatility, because if it was like 100% invested in the S&P 500, in almost any 20-year period, there'd be enough volatility to bring the thing down so your initial capital goes to zero.
But not the full capital.
What? Not their debt?
Not your leverage capital.
No, they're going to get paid. I think this is pretty clever. Almost any finance student sat around at some point when you're 20 or 21 and said, oh, I figured it out. Stocks go up over time, especially in economies like the U.S. I just need to find a way to get some leverage.
Yeah.
Well, and so there's a brilliant business model. I just got to get people leverage. And then you start running the numbers. You start looking at the alphas and betas and everything else, and you go, oh, stocks are way too volatile to do this. I'd have to charge a ridiculous amount on the debt. So they played with that equation until they're like, if we bring in enough corporate bonds, basically, we can reduce the volatility to kind of make this work. So our financiers will be willing to write us a check. But the only people getting rich in this game, with the exception of an occasional person that signs up for this and has the perfect 20-year run, is the financiers.
You're
This is
missing
where are
part
the
of the.
customers' yachts, Douglas. This is totally what it is.
I agree with your points, and one thing that I believe is missing from what you're stating, and it's a reason why the last 20 years is important here, is because what I personally in this here podcast, this here episode, want to point out is how things can look so good on paper. And so I don't want to throw out the fact that, like, the sales pitch, I don't want to throw that out, because I think if you take your average person that is looking for a leg up, you have to first take that full argument into account and say, yes, this is possible. And then you have to go, it's really only possible in the circumstances in which you live and die with basic capital. Like this organization that just started, you have to say they're going to be around in 30 years, and I will have no interest in shifting off of them in 30 years. But I think first you have to say, what's the mindset of the individual that's coming in to do this rollover to start with? And it's so easy.
Deep breath. We don't give financial advice on the show, ever. How we invest our capital is not how you should invest your capital. We give research recommendations, and when we see something that's especially egregious, we try and call it out, just like to be decent citizens, okay?
Which this is.
This is especially egregious. This is one of the worst investment products I've ever seen. I understand the appeal, but your example there, yes, you're totally right. You should try and explain why this might appeal to some folks. Dude, run a 20-year back test on taking out as much leverage as you can possibly get and investing in NVIDIA or Bitcoin or whatever else. Like, this is getting to the point that it's, sorry, that's a little unfair to you, but it's a little nonsensical. I can give you a back test of anything and make it look amazing and make it even look more amazing with leverage.
Even during this period, the reason why the backtest works is because of the leverage. What you stated, the initial capital will do, like during that 40% drawdown, that initial capital does not look great, but you're still paying them. Like, you still exist because of the leverage. And that's what people miss. So your point fully, like, I fully agree with what you're stating, but that is the part that people miss. Because if you just run the spreadsheet, the spreadsheet runs off of $500,000 in capital. It doesn't run off of $100,000 in capital. And what is missed in that scenario is the fact that you have $400,000 in debt. People just miss it. When I say they miss it, I don't mean that they don't realize it at all. But it's easy for that to get lost when now you feel like the $500,000 is mine. I think that people during up markets, after they put their up posit in, or whatever I said earlier.
Yeah, that's right.
Like during up markets with their house, it's easy to say, my house is worth this, therefore, like, that's mine. And
so many people right now think their house is worth $1 million when their house is just a pile of debt.
Yeah, that's the point.
Solid.
And with stocks, I think it's even easier, because the natural place where people's heads go with stocks is that they go to, like, the trading, not investing. And part of the brilliance, not of the product, because to your point, this product I think is absolutely egregious, and I would stay away from it in all circumstances. Part of the real reason that the marketing behind this can be brilliant is because they go into retirement, where people naturally are like, oh, well, I'm a long-term investor anyway, so all this stuff plays out in the long term. Like, I think it's easy to get people's heads into that place, which makes this even more dangerous.
This is why I tried to start with the disconnection between, like, a true market, right? All these fees are hidden. They are withdrawn on the back end where you can't see them.
Yeah. You don't pay them. They come out of your investments.
I mean,
that's the line that's
until your
used.
investments are worth $0, which the counter-cyclical case where that person still has $100,000 and they roll it over and there's some ups and downs. There's basically never, especially with this asset allocation, there's never a case where that goes to $0. In this, when you throw the leverage on top, like I said, the rough analysis I saw is like there's a 20% chance of that. Those are not good enough odds, people. Those are not good enough odds. With leverage, your debt is owed at the most inopportune time. So let's say we are, I don't know, we're going to pick on Gen Z for a second. Let's pick on millennials, actually. We are a millennial who feels left behind, and we just decided we're going to ride or die. You only live once. And we are going to do buy now, pay later on our burritos. We're going to take a mortgage for absolutely as much as we can get. We are going to use something like basic capital to lever up our 401k, and we're going to run crazy credit card debt.
Preach it.
No, I mean, if we have the most magnificent next 20 years, that person, well, the credit card debt and the buy now, pay later are stupid regardless of what the environment does. But the leverage 401k, the leverage house might turn out all right. They might. You might survive that. But man, if you don't, everything your retirement balance goes to zero at the same time that your house value drops by 30%. And you may be forced out of your house. It snowballs in a way that puts you in financial jail for the next 30 years. There's no reason to take the risk.
And here I think is the most ludicrous part of this, and it has nothing to do with the product itself. I mean, it does, but it's what I'm going to talk about is not the product. A backer of this is the next Warren Buffett.
Stop. He doesn't eat McDonald's every day. I mean, come on. He's not even.
No, but this is where we had the episode where we discussed Bill Ackman and how Pershing Square, through the purchase of Howard Hughes, is going to create the next Berkshire Hathaway. He is continuing. Our belief
self-described.
Yeah, our belief
crazy
is that.
fees. So we push back.
Sorry. Yes, we push. Great clarification. We discussed how he is saying self-described that he's creating the next Berkshire Hathaway, and we were like, no. If you look at the principles of Warren Buffett and Charlie Munger and Berkshire Hathaway, it violates nearly all of them. Backing this product and just going according to everything that you just said, everything that you just stated that this stands for and pushes for, and the small chance of success with a large chance of failure is everything that Warren Buffett and Berkshire Hathaway are against.
I'm going to surprise you here. If someone came to me with this investment opportunity, I wouldn't immediately say no. I'm intrigued as an investment in the company. Because, as I said, this is where the customers
You're wrong. You would never invest in this. You would never invest in this.
You're probably right. But I would take a week and I'd talk it through with people. The people backing this will make money.
I don't know if they will. I actually don't know if they will.
I kind of think they will because the fees are so good.
No, they are. Assuming the product lasts. Assuming that the product lasts. You're investing in this product at, we don't know where we are, but if you fast forward 10 years, most of the analysis that exists right now is saying that the U.S. stock market specifically, I don't know about the bond market, the U.S. stock market specifically is going to be going down. You start to do this at the top of a market. I'm not saying we're at the top. I don't know. But if you do this at the top of a market, it's very different. The classic portfolio
for basic capital only owns 15% equities. It's almost all debt. So if I was an investor in something like this, I would write them the seed check. They would go raise a bunch of AUM that gets placed into debt. I would charge a crazy amount of fees on that. And Bill Ackman is one of the highlighted investors here. He's going to make money on this. Now, is he going to make money at the expense of the investors?
Yeah.
I think he is.
If he makes money, he will make money at the expense of everyone else. Everybody else.
Yes.
However, I don't believe this is going to make money. I do believe that this is a product that could make money, but I do not believe that this is a product that will make money. I do not believe it's going to get enough of a foundation of customers and enough acceptance for it to really make money for people. That's my belief.
Here's what I'm trying to say. It's two different things. If this is a good product for society and if this product will be good for its owners.
Yeah, but people have to buy it for it to be good for its owners. I'm saying I don't think it'll generate enough revenue for the business to make money.
You know, the financial community, Doogles and I are probably more ingrained than your average listener here, right? But the financial community almost universally hates this in a way that very rarely happens. The last time I can remember the financial community hating something this strongly was pretty much tariffs. I mean, like, there. Anyway,
So like in the last 6 weeks.
Yeah, but that's a very rare example. There's one before that was a crazy high fee product that I'm blanking on. But anyway, this happens, I don't know, 3 or 4 times a decade that most of the financial community universally hates a thing as much as they hate basic capital.
Yeah.
So to your point, maybe there's no assets under management because anyone getting good advice, like I think of this from a company, its owner's perspective. I would never make this my 401k plan. It is swindling your employees.
This is why, and we don't know what's going to happen, but my belief is this is why I found the example of the IRA more interesting. Because I see this as a case where I think the B2B component of this, because of the namesake of investors, you might get a spike. Like you might have early traction, whatever, but I doubt that it sticks. And I doubt that it becomes something that goes beyond the more small business side of things. I just doubt it. So then I start to look at retail investors, and I think retail or individuals in general, individuals starting to look at something like this and being like, yes, I want that, because that's basically the equivalent of my employer matching, except I don't need an employer. Like I can see people start to go down that road. And that's the place where when I come back to the top of the market element, I think their portfolios start to fall out underneath of them. And then it does not hold. That was my take. I don't think it has a lot of B2B traction. It might get some early on, but I don't think it lasts. So then I think the B2C market's the one to look at. And I don't think that will either sustain the business, nor will it stick if we end up being at the top of the market.
In the IRA example, do you get a pick? Do you get to decide your asset allocation?
I think it's just an IRA.
It's fairly fixed, right?
We can look into that. That's not core to the general conversation.
Yeah, I think my point, and all the spreadsheets I saw online where people did some analysis here, assumed their asset allocation, which again is 85% bonds, which no one would ever do. Like if you just invested your 100K, you would struggle to find a financial advisor who would be comfortable with that asset allocation. And that asset allocation in normal markets sacrifices the return that you can make. So there's too many sacrifices here.
Yeah. You might be right that even the IRA is, I don't know, but I just imagine it's an IRA, so I imagine that it wouldn't be.
Because, I mean, they have to underwrite the product, right? So if I roll over my IRA, take their leverage, and buy a bunch of garbage stocks, I don't understand how they underwrite that debt. I really don't.
I was assuming at least they had like a swath of ETFs that you could buy from or something. Maybe not. All right.
Anyway.
Can I transition us to the next topic, or do you want to close
please do.
Yeah. So the next topic I want to touch on is more in the fees that are paid in other areas, specifically trusted financial advisors. You can roll that into other things like high expense ratio mutual funds. There's other things you can roll it into, but I want to talk about financial advisors, which we've touched on here on the show before. Do you want to give any context or background or anything before we hop in, or should we just hop in?
I'm just going to save Doogles on the email box from getting a bunch of angry emails. In some cases, and in the right cases, if you know what you're getting into, there can be a great investment on a financial advisor, even a fee-based financial advisor. Unfortunately, that just seems like the exception more than the rule. And I think what Doogles will talk about is a lot of people aren't even aware of how that model works.
That's all that's important. If you at the end look at the full cost of something and determine that you believe that you're going to get the benefit of that in the end, then pay it.
This is my point. As long as people understand the costs and willingly sign up for that exchange, it's great. Unfortunately, everything's hidden.
Yeah. So similar, I'm going to use a similar starting point. You're going to yell at me for that, so I'm just going to preempt it. Similar starting point for this investing example. Let's say that you go to a financial advisor, and the average fees that you're paying for a financial advisor that pays based on assets is somewhere between 0.5 and 1.5%. I'm just going to use 1%. Keep the math simple. If you go to them with $100,000 and you say, I want to have you as my financial advisor, please advise me financially. Okay. They do that, and I'm going to take the stock returns in the last 20 years again. Keep it simple. I know they're not going to just do stocks, but I'm just going to do this to keep it simple for the math.
Mhm.
You go to them with $100,000. They're going to take a 1% fee over the course of that $100,000. You stick with them for 20 years. At the end of that period, you would have paid almost 25% of your money to your financial advisor.
Yes.
So the numbers, if you didn't go to that financial advisor and you bought SPY or something like that, you would end up with something around $650,000. So similar to the last example we talked about. In this case, with the financial advisor, you're going to end up with more like $480,000. And so that's the difference there. So the reason we're saying that is, to your point earlier, not saying that money's not worth it, don't do it. It's asking yourself, I think, for two things. There are two questions I personally, at the simple high level, would say people should answer. One is, do I believe that this advisor will make better financial decisions than I will? And it's worth it that way. The other question is, do I believe that there's a psychological advantage to someone else managing my money versus me managing my money? Which there can be. In either one of those scenarios, I think your answer could be yes. But it's important to go in with eyes wide open. In this case, the fee, I believe, is, I'll say one, fairly simple and transparent in 1% a year. What I think folks get lost in, because
it's not that
easy
transparent, unfortunately.
Okay.
It's not, because you don't, in the case of where you have millions of dollars in the account, you don't write your financial advisor a check for $60,000, which is what it might cost.
Okay, so okay, hold on. Let me finish. Let me finish. Okay, so the fee that you're like the amount, the percentage. Let me say the percentage that you're going to end up paying, I believe, is transparent, and that the person has told you you'll pay 1%. You will pay 1%. I think the place where it is not transparent, maybe there's two places it's not transparent. To your point, just like we said in the last example, you do not pay it like. It's not an active payment. It's a passive payment that comes out of your investment, so it's easy to miss. That's one. The second is that human beings, do not naturally understand the exponential nature of compounding. And so I don't know if people do this math or not. I do not know. But I could see someone being like, all right, if I pay them 1%, you're going to take 1% of my money. I get it. Not 1% compounded over.
Yeah, not 1% that equals 25 to 30% of your total wealth at the end of 30 years. Yes.
Exactly. So I think those are the two things.
Why do you do this to me? And then there's there's the good players, and then there's I'm trying not to drop a name, but we just have to. Then there's folks like Edward Jones that might charge 1% or more for the financial advisor. Pays for the office, pays for the secretary, pays for all that other nonsense, and then places you in their funds, which have ridiculous fees, often another 1 to 1.5%. The worst abusers of this put fees on top of fees on top of fees, and will take like as much as 50% of your future wealth in a way that's not transparent at all. So
you keep going.
No, go.
Whereas if you decided that you wanted to keep things simple and just went buying Vanguard ETFs, a Vanguard stock market ETF like VOO, VTI, which is 500, S&P 500, or total stock market, you're going to pay like 0.03%, something like that over the course. That's annually, compared to what you were just saying, 1%, then that might go to 2% or whatever it might be. Annually. Yes. It is such an order of magnitude difference. It's wild. And that's the question of, is it worth it? You just have to answer that. And the answer can be yes. But you have to answer whether or not it's worth it for you.
For certain providers, the answer cannot be yes. I mean, I think Raymond James is particularly egregious too. If any financial advisor is talking to you about loaded funds and upfront costs and 6% fees or what, like, there's some really terrible products out there.
Yeah.
The potential option for a more savvy investor that still wants professional advice could be fixed fee financial advisors, where they pay you for the hours they spend on your account. We've recommended that before. I mean, I think those robo-advisor solutions are pretty solid as well, and they might take 0.25% of...
They're still not cheap. relative to others.
But you do the analysis on a 0.25% versus 1%. Sorry, I don't have it in front of me, but it might take 3 to 5% of future wealth rather than 30% of future wealth. Like, it's a step change different in terms of its compounded breakdown.
Yeah. Think about it. That's what's important. And look at I love that you went down the road of looking at, there's the fee that is the management fee. Then there's the fees of the investments that are also being taken. There's a piece this week by Jason Zweig in the Wall Street Journal that was looking at investments in private credit and now potentially going to some 401k providers. Mm-hmm. And he took the example, I think it was like Redwood. I think that was the name of the organization that he was looking at. And in a similar way to what you were just discussing, he started following that trail. It was like, so if you invest in their, I think it was like a municipal bond fund, that municipal bond fund also buys like their stock market ETF. He's like, how, first of all, they're investing in something that regulatorily is okay, but isn't something that you said was okay. And now they're investing in something that also has its own fee that gets paid back to them. The incentive structure there just becomes quite messed up.
Well, in addition to the fact, that's where we were just talking robo-advisors, right? There's other hidden fees with robo-advisors. For example, Schwab, their robo-advisor has minimal fees, but it has fixed allocation into cash, and that cash within their robo platform, they do not pay interest on. So they take that interest, and it's a hidden fee that they don't explain. I mean, stuff is complex. It's way harder than it needs to be.
All right, that's a wrap for the standard episode. For premium subscribers, we got Inside the Trade coming up. We're going to talk about a few things that we are personally researching that we might find interesting in case you want to take that as a research recommendation for yourself. So premium listeners, please stick around. Everyone else, see you next week.